Good afternoon, traders. This is Christian from Hertz Trade Group, and it is Friday, February 11th. So end of week video. Risk disclaimer in front of you. Everything that we're going through is for information purposes only, not giving out any advice or recommendations. Crazy week, right? All kinds of price action. We had, if I remember correctly, a little bit dull price action on Monday. Tuesday and Wednesday were a rally back up. Yesterday was all over the place, really got pounded at the end of the day with comments from Fed speakers. And then today was, we've got multiple problems. We've got multiple situations going on, like all over the place. So let's break some of this action down and try to come away with some thoughts to kind of build on for next week. I did this video last week just for members where I kind of went into more into positions and how to kind of position in this market going forward, and just kind of to how to basically try to handle this volatility that we're getting on a day-to-day basis. So let's go over the numbers first, and I'll get back to the to the goal of the video, which is to try to look to see what's trending and understand what kind of market this is, and kind of go from there. So S&P finished down 2% for the day. Big under. I don't have the proper things all coded here, but I started just highlighting a couple things that stood out to me. The Qs were down over 3% for the day. And the small caps actually outperformed a bit for the week. They were down 1% today, but here's the performance for the week, which I like to do, when we do get to the end of the week. You can see that the small caps actually gained for the week, up 1.4%. What's interesting to me about this is it's kind of counterintuitive, right? I think everybody's looking at this chart of IWM and saying, oh geez, we've got a big breakdown. I think it's even better on the weekly chart. We've got a big breakdown, and at some point this thing is going to stall in here. Now it may have already stalled, but still, I think that this has been the weakest area of the market from what I see, technically. And you would think that the small caps would continue to underperform, but they're not right now. I mean, so if you actually played that game of doing probably the opposite of what conventional wisdom is, and you went long IWM and you went short the Qs, you would have had really nice outperformance in that direction, right? So you could see IWM was at 1.4% for the week, and the Qs were down 3.1% for the week. Let me just double check my spreadsheet just to make sure that is right. Yeah, Qs were down 3.1% because it's so similar to today's performance, and IWM was up 1.4%. So there you go. And if you look at the outperforming sectors, metals and mining, interesting. You've got some just odd things that just stick out, like which one or which things would you not think that would belong in this situation? Pot stocks were one of the best performing groups this week, up 9%. The gold miners really, today alone, the gold miners accounted for that almost all that performance. They were up almost 6% for the day. They finished 6.6% for the week. Oil services, steel names, and then just a variety of different other areas in there. Even though the banks, I think, were down decently today, they still finished up 1.6 for the week. And tech semis, consumer discretionary, some of your bigger areas of the market underperformed. So before we get into international, which I don't know if there's really that much I want to go over here in international, but EEM was flat for the week. International develop was actually down for the week. And here's how the stats for things like TLT and gold for the week were. I'm going to get to those in just a second, but I think let's go back to the S&P chart, and let's kind of look at this weekly bar for a second, right? So definitely this ran out of steam, right? But it's still kind of holding this weekly level. We know that we're in value, and depending on what your time frame is, like for my time frame, I look at more of the 200-day moving average on the daily chart because I'm trading more of this time frame than really long-term positions, again, in my trading account. So that's a break of the 200-day moving average. For me, that's kind of a hands-off area. I mentioned that going into the week, I thought that we could break either way. And my if you go back to my comments from last week, which probably will take me a while to get back through. By the way, this is what we do on a day-to-day basis. I don't put all these charts on Twitter, but you could certainly see that I put out the S&P chart analysis and everything like that, as well as the Qs, IWM, and bonds. I put that out for members every single morning. We do that. Did I go back too far? Here we go. Yeah. So I said basically, I said my take is 50-50, right? So, but which way that we could basically break, from where we started for the week. It ended up that we did a little bit of both. You could have been right on saying that we were going to have some good performance to the upside, right? Which we did. We did not take out the highs, but we rallied significantly by the end of Wednesday. That's the good. The bad is that we negated all those gains, right? We had in the S&P futures, we had a bearish engulfing bar yesterday, and then decent follow through to the downside. So we're now back below the 200-day moving average. I will give you my interpretation of how I trade this, but you may have something different. You may want to be thinking, hey, what happens in here? Do we make a higher low? Do we come in? Do we test this 42.78, which is the bottom of value for the month? I don't know, and I know that this is a long ways away. So for me, it was the 200-day moving average, and I lightened up on some positions. I am still carrying a couple swing trade positions, mostly in like the energy materials space, but I took the necessary thing. Like I was holding a bank name, I was holding Morgan Stanley. I took that off today. I had already taken multiple targets in that trade. I think I mentioned that on even on Twitter the other night. I said, hey, just to let you know, I took targets in that, and so this way I locked in a good portion of the profits in that trade. So this happened as well. If we rewind from a month ago, right? I made a mistake, and my mistake, I made a few mistakes last month, but one of them was, hey, I was watching the 50-day moving average, and I said, well, you know what? I'm going to be a little bit relaxed with my risk here, and I think that we could get down to the bottom of value and then bounce. We never saw that bounce, right? The bottom of value. And the other thing that was significant here was that the 50-day moving average, once we broke it, there was a long way to get down to the bottom of value, right? And we didn't really hesitate with that. It was once we broke the 50-day moving average, we had one day where we tried to regain it and failed. And then the next day it was a big whoosh down, kind of similar like to today, but actually a little bit more dramatic than that. So I'm not going to play that game again to say, yes, I know where there's some support, but we're just too far away from that. Right. That's a decent amount. It's a decent percentage difference to get all the way back down there. Right. And here's what the 1 hour chart looks like. The other thing that I said in yesterday's video was for the super short term, which is what I look at in the 1 hour chart, is that if we broke this 200 period moving average, I said this in the trading room yesterday, that I would be lightening up on positions. I did that yesterday. I killed 2 or 3 positions, I think, and I killed 2 today. Right. So again, I'm sticking to the plan, right? I mentioned when I sent out basically my mistakes that I made in January, I said, I'm not doing that again. I'm being super disciplined and making sure that I'm marking my levels of where my trades are going to be wrong, and I'm going to reduce risk. And that's it, right? The name of the game is it's okay to be wrong, right? And if you're somewhat of an experienced trader, you know this rule, right? You know that it's okay to be wrong, but it's not okay to stay wrong. Right? It's all about defining your risk and making sure that that if you do have losses, which everybody does, if they're being truthful and honest, right, that you're limiting those losses to small losers and not big losers, right? That will make or break your month. It could make or break your week, your month, and your year, whether or not you have big losers or small losers, right? Small losers, no problem, right? And cutting them very quick will help you, especially in a volatile market like this. Yeah, what else did I cut? I cut Blackstone today. Here's what I cut yesterday. Baidu, CCJ, Schwab. I reduced Deere, and I got out of Huntsman. So I made all those. I made a decent amount of decisions yesterday once I saw the writing on the wall that we were not gonna, that we got below this 200 period moving average, or we're very close to it. Yeah, it should be, yeah, here's Blackstone in here. That actually went a little bit below my cost basis after I took some profits in that one. So again, trade management, risk management, very important in this situation. Also, like a couple trades that I put on earlier, they worked pretty well for day trades. Sometimes I convert day trades to swing trades. I'm not doing that right now either, even if the trade works really well. Right? If I started off, if I said it was going to be a day trade, it's going to stay a day trade. Right? Not going to change that view. So that's the S&P, and that's what that told me on the 1 hour. Again, defining the levels. I think I said in yesterday's video, well, we could still come in here and hold value. We did that for a little bit, but you could see that we closed below it. So let's move over to just a couple other things. I'll talk a little bit faster. NASDAQ, right? So 1 hour before I even go to the daily chart, notice that we fell all the way down to this version point of control, right? So if you were playing shorts, that's where I would be covering a bit, right? Or at least covering a good portion of your trade, right? Depending on what your view is. But again, these things act like magnets. Version point of controls, again, very, very important in my trading, right? And what's really nice about the market webs and how I use the value areas is that it really lets you separate emotion from your trading. You could say, hey, if we're coming into this support, this is resistance, this is what I'm going to do, right? And it really helps you kind of pre-plan out your trades. So do I think that we're going to stop right at that 1 hour VPOC? I don't know, because if you look, you've got mixed signals. You can see that we also did break value. Notice that this was in kind of an ominous side. I actually drew this, I think, this morning in today's pre-market session. This was not a good sign that we made a lower high here and we got stuffed at the 200-day moving average. Again, notice how quickly this stuff is happening, right? You have to really be quick with what you're doing right now. All it takes is you can't hang out and say, hey, I'm going to give it a little bit more time. But like as soon as we got rejected at that 200-day moving average for a second time, I didn't think that that was a good sign. And once we started to kind of back away from it, what I said this morning was that, hey, be mindful of this relationship. We're going to eventually break one way or another, and it's not looking like it's going to be to the upside. So there's your break to the downside, and we have to see. I mean, we could stop here. We're now, we're being driven a lot by news at this point and headlines, right? We got a couple of those situations this week that are really pushing the market. So yes, we could hold in here. It's a possibility. Do I want to really play for a huge move to the upside? No, because I don't really know what's going on with, whether or not Putin's going to actually do something in Ukraine or not. I don't have any edge in that situation. What you can do, and that's where options come into play, is that if you're okay with taking a shot at something, you can only lose the premium. If you want to take a shot to say that there's going to be a bounce off that version point of control, I would do it with a small option position, right? So that you're defining your risk, so that your risk is the premium, and you make it so that that's a manageable trade in terms of a paper cut loss, right? Meaning probably not a big trade to put on, right, for a risk like that. But if you could frame it in terms of a short-term trade and only lose the premium, and that should go into your overall, thinking in terms of risk. And again, if you don't want to sacrifice the premium, then that trade's not for you, right? But that's the way that you have to think about short-term option plays, in my opinion, is that you're taking a shot at an event, and it's either going to go one way or another. And keep in mind the VIX is up to 27. So the options are not as cheap as they were. Remember, just I think on Wednesday, we were under 20 in the VIX. So again, fast moving market. And then IWM, which I thought was really interesting. It did finish below last week's lows. Notice where this also got to for IWM. Upside VPOC, gone. Right? Just really, really telling with some of these situations, right? So again, these are all automatically drawn in for us, and they're all based on significant levels based on volume at price, right? This version point of control, which is as far as we went to the upside, was the most volume that occurred in this period, right? I'll put something out about this if you're unfamiliar with this concept over the weekend, right? So that's that. And, you know, again, just an example. I talked about this in the midday video. You know, the Affirm, by the way, same thing, got up to that 1 hour VPOC, right? Which is from here, right? Again, we define this by price not passing through the point of control for a given period, and that creates a virgin point of control, right? If the price passes through the point of control, you know, like it did in here, then it does not create a virgin point of control, right? That's the way that that works. Notice that there's one behind here too, right? Which is all the way up here. Now we may not get to that, you know, and these only become significant once you're trading outside of value to the upside. The ones to the downside become interesting or significant once you're trading below value. All right, hope I'm saying that correct. But again, what's interesting about this chart to me is how fast this move. This was at 80 bucks, the stock, just yesterday. It's almost down 50% from there. So again, just gives you a sense of the volatility that we're dealing with. Now, of course, there was earnings involved in this, but still, that is a humongous move, one-day move. All right, so I'll get to the conclusion here in just a second, but I wanted to talk about, you know, I talked about how IWM outperformed and how Q's underperformed. Another chart that I started with last week was talking about, and if you remember, you know, because I spent some time talking about this concept, but this market is much different currently than what we faced in 2020, 2019, 2020, 2021, when basically we had a lot of things that were in uptrends, right? A lot of stocks that were in uptrends. It wasn't very good for shorting, right? Because the trends were all up. Now we're seeing something different, right? And this reminds me, but the opposite, going back to 2014, 2016, right? We saw a market there where energy went down about 72% from high to low. And meanwhile, while energy was going down, everything else was going, I shouldn't say everything, but a lot of other things were going up over that same period. And again, these are approximate numbers, but the same period where energy, XOP ETF, went down 72%, XLK went up 16%. Right. So back then in 2014 to 2016, if you were trading both short and longs, right, and were managing like a long short book, it could have worked very well for you. Now, the years past, that strategy didn't really work as well as it did in those years, right? Because again, the reason why is there's just a lot more things just went into uptrends and, you know, basically stayed in and defined uptrends for a while. And I think that we're back in that market again in terms of long short, right? And now it's the other way. Energy is outperforming and tech is underperforming. And these things do go in cycles, right? So I just sent this tweet out. And, you know, if you look at the performance for the week, right, this is what's trending right now, right? So you could guess as much as you want to, and when this trend is going to stop, right, where energy is outperforming tech. But I'm not going to predict that, right? I am going to play this out for as long as I can and try to be on the right side of the market, right? My job is not to make the predictions. Again, I will look at the technicals, and if I see an important technical level, like I think 101 is in energy, right, I will be cognizant that I probably want to be taking some profits. We talked about this in the trading room this week a lot, this version point of control, right, and how nice and how clean this was in oil, that we just checked back to the top of value. So normal digestion after a VPOC. And I thought that was actually bullish, right? And we've got a bunch further up here, 97, 101, 106. Again, these things can be taken out. They don't have to be taken out. They also don't have to be taken out in a straight line. What I think is significant is this 101 VPOC up here, right? So anywhere 98, 101, I think is something that we could get to, right? I think all of that is possible, right? And especially if there is further, the more prolonged this potential or actual situation with Ukraine is, that could be taken out relatively quickly, right? There's another chart that I thought was interesting, and I don't know if I have that up anymore. Oh, I must have taken it down. But I thought Ryan Dietrich's tweet was particularly really good for what we're dealing with right now, right? Whenever there's these global, geopolitical events, right? I think this is really good because everybody at that, everybody's, I don't want to say everyone, but this starts to really get into people's head about how far the market's going to move on a potential geopolitical event. And if you look at how quickly the market recovers for stocks, for whatever reason, I don't have the exact answer, or I could try to theoretically put something together, but stocks are able to shake this off very quickly whenever there's one of these. Now, does it mean that every event is the same thing? And could this lead to something else? It definitely could, right? It definitely could. But, even the Pearl Harbor attack, right? Total drawdown was 20%. And you could see, he's got days bottom to recovery, right? We did get over that, right? And I even put together this chart, something that I remember, back in 1990, I wasn't trading then, but I was in school. I remember when Iraq invaded Kuwait, there was a spike up in oil, and then it went right back down afterwards, right? And there was other situations too. This is just crude. This isn't overall equities, but you got to be careful with these geopolitical situations. Is that usually it's a temporary move, and the temporary depends on how big of a conflict it is, I guess. All right, here's what happened, of course, back in 2001. So in any event, these are things to be mindful of. You have data for other geopolitical events, conflicts, and you could see basically how they play out. You could also just look at a long-term S&P chart too to go over these events, and I think it just helps puts these things in perspective. So is it possible we could take out 101 and then fade from there? Sure, good. Like I said, we also don't have to take that out right away. All right, so I wanted to talk about that trend, those trends that are going on. Also, if you want to look at the S&P and the Qs, I think that there is something changing here. The Qs have outperformed for a long time. Sometimes those cycles, they come to an end and things revert. So SPYs, this has been basing now since the middle, since the middle of 2020. And we've had various periods in here where it's been back and forth like this, but maybe the SPYs really start to outperform the Qs, right? Another funny thing that I was talking about IWM and about how that most people think IWM is going to underperform, but it could be the Qs. And I remember another funny thing that anyway, I find humor is that last year, I saw so many posts about, with the one picture of stilts, like holding up a building or something like that. And they put things like, they said each stilt was one of the FANG names, the Google, Amazon, Facebook, Netflix, right? And people talking about, oh, this is no good. These stocks are holding up the market, right? Now, and people were saying the same thing, right? That was no good for the market. Now I see the opposite. Oh, geez, Google's down, Apple's down. That's no good for the market. So either way, it's funny, these narratives about how either the FANG stocks leading or lagging are both bad for the market. I think you just have to look a little bit. I think you have to look a little bit deeper than that, right, to see if there's other participation going on. And to also understand how an index works, right? By definition, the biggest names in an index are going to push around the overall market, right? And you could make decisions based on that, right? You can change your weight, you could change what you're investing in, right? There's no one that has a gun to your head and says that you have to own the market cap weighted indices such as SPY. You could also own RSP, right? Which is the equally weighted S&P, same index of the S&P, but equally weighted rather than market cap weighted if you don't want as much exposure to those FANG stocks, right? So there's decisions that you can make, right, to minimize some of these impacts, right? But I do find that this relationship is important. All right, so let me get just back on track with, I mentioned in the beginning of this video that the way to kind of trade this market right now. And I think with these types of moves and the VIX, which will bring up the VIX, like the VIX weekly, right? Here you go. So far, we do not have a higher peak, right? But I think right now, what is really working right now is basically being very objective right now, and understanding that not only the energy names are trending, but also the commodity names have done very well, not to the same extent, but they've done pretty well and they're in uptrends, as well as there's some other areas of the market. We talked about leisure names, and we talked about how well some of these reopening plays have been doing. So there's going to be, I think, this market, take it for what it is a really good market to be coming in for the day and not having that many positions, and being objective to what this market is going to give you, and being open to playing both sides of the market, right? Some long, some short, right? And that's kind of the theme that I wanted to mention, is that this could continue for a while, where we're seeing good opportunities on the short side and good opportunities on the long side. And the way that I would kind of set that up every day is to do your chart studies like we do on a daily basis, and basically come in and say, this has potential to move to the upside, it's trending, and this is potential to move to the downside. I think that's kind of the most important theme. And the other thing that I mentioned about the S&P being market cap weighted, right? I say this quite frequently in these videos, that my bread and butter is swing trading, right? But if the market is not giving me great opportunities, and if the volatility is too high, and the intraday moves are greater than the overnight moves, which is not historically the case, then you do something different, right? And you adapt to what the market is giving you, right? You don't stay stubborn, right? Just like a similar thing that I see, that there's just too many traders. And I don't mean this to be like horrible or make fun of people, but there's just too many traders on Twitter that are just growth traders. Really, you're just going to participate in that area of the market, even though there's other areas of the market that's trending? Why would you do that to yourself? And does someone have a gun to your head saying, sorry to use that expression again, but is someone forcing you to only be a growth trader? The only one who's stopping you from trading other parts of the market is you yourself, right? And the other way that I would help, like if you're a trader who over the years has only looked at certain, let's say the FANG stocks and maybe a few other stocks, then what I would do is get help, right? And I'm not saying join, my trading room, but join someone else's trading room, trade with other people, right? If it's not a trading room per se, reach out to other people that are in a group. They will help you spot trends and go through in other areas. But that's the value, I think, of, there's so many negative connotations about, joining a trading room. And I get it. There's a lot of bad apples out there. And, there's a lot of shysters out there. I know it. I worked in Wall Street for a long time. Wall Street is full of shysters, but, but you have to find, what you could do is you could find a group that helps you to kind of get over, some of these things where somebody's telling you that you only have to trade growth stocks. That's BS, right? You have to adapt to what the market is giving you, because I'll tell you, if you go back to this, right, and if this is something for you where you're a trader, you have such an advantage over a hedge fund, or a fund that says, hey, I'm just a tech fund, or I'm just an innovation fund, or I'm just a growth fund. You could do whatever you want to as a retail trader. That's the beauty and the flexibility that you have. But if this trend continues, or SPY continues to outperform the Qs, you're going to have to find other areas of the market. And there's some crazy moves going on, right? And even like, I don't trade, I try to get involved in basically anything that's trending. But look at the move in British American tobacco, right? So there's money. It all depends too if you want to make money or not, or if you want to be stubborn, right? But like, here's something that's been trending for a while. Even the Philip Morris as well. And I can't actually, you can't always explain every single move. But these are, again, this is just one example. We do this every day where we look at different groups, but money's money, right? So anyway, I'm going to end the video here. Thank you guys for listening to me for a while, but I thought it just, given this week and what we're seeing in this market and how it's changed, right? You gotta identify what's going on in the market, how it's changed, what the trends are, and be able to adapt and be objective and be willing to kind of change around what you're doing, to make the adjustments to the market. The market is not going to change to fit your system, right? You've got to tweak it and you've got to adjust it so that you can make it work. And I'll tell you, I went through this, last month, where I was trying to do it what I just explained, but the wrong way, right? And since then, I've just been much better. Not to say that I haven't had mistakes or anything like that in February, but I feel much more comfortable. I'm on the right side of the market more frequently, and not arguing with the market. All right, I'll leave it there. I could go on for longer than that, but I'm not going to. Guys, have a great weekend, and members, you'll get my video obviously this weekend more in detail.